You've got your brokerage account open, you've got some money deposited, and you're staring at the search bar. 1,000 different ticker symbols are flashing through your mind. Apple, Tesla, Microsoft, that new electric vehicle company your friend won't stop talking about. The question is overwhelming. How on earth do I pick just one? This isn't just about money, it's about making a smart decision you won't regret. What if you choose wrong? What if the stock tanks right after you buy it? This pressure to pick a winner stops many people from ever even starting. But what if I told you that picking your first stock doesn't have to be about complex formulas or insider tips? What if it could be a simple, logical, and even enjoyable process of discovery? Today, I'm giving you a step-by-step, beginner-friendly framework for picking your first stock. This isn't about getting rich overnight. It's about making a thoughtful choice, learning from the process, and taking a confident first step into the world of individual stock investing. The very first and most important step is also the most overlooked. You must start with what you already know. This philosophy was famously championed by legendary investor Peter Lynch, who said that the average person can spot fantastic investment opportunities in their everyday lives long before Wall Street analysts do. You are surrounded by companies. Look at the brands you interact with every single day. What's in your kitchen pantry? Is it Coca-Cola, Pepsi, or General Mills cereal? What's the logo on the shirt you're wearing? Is it Nike or Lululemon? What apps are on your phone's home screen? Is it Amazon, Google, or Spotify? What stores do you enjoy shopping at? These are not just products and services, they are potential investment ideas. The huge advantage of starting here is that you already have a gut feeling for the business. You understand its customers because you are one. You can see if a product is gaining or losing popularity. You have a sense of the brand strength. This is your circle of competence, and it's the safest, most intelligent place to begin your research. Don't start with a complex biotech firm you read about in a forum. Start with a company whose business model you can easily explain to a friend. Once you have a short list of 2 or 3 companies from your everyday life, it's time to put on your detective hat and ask some fundamental questions. This is where we move from a gut feeling to a more reasoned analysis. The first question is the most basic. What does this company actually do to make money? This seems obvious, but you need to be specific. Apple doesn't just make iPhones, it sells services like Apple Music and iCloud, and it earns a commission from the App Store. Amazon isn't just an online store, it runs the massive Amazon Web Services cloud computing arm, which is a huge profit driver. Understanding the revenue streams tells you if the business is diverse or reliant on a single product. The second question is it a profitable business? This is crucial. For your first stock, you should strongly favor companies that are consistently profitable. You can find this by looking at their net income or profit over the last several years. Is the line going up and to the right? A company that loses money is far riskier for a beginner. The third question is, do they have a competitive advantage? This is often called a moat. What protects this company from its competitors? Is it a powerful brand everyone knows, like Coca-Cola? Is it proprietary technology that's hard to replicate, like much of what Apple or Nvidia does? Is it a network effect, where the service becomes more valuable as more people use it, like Meta's Facebook or Uber? A strong moat means the company can fend off competition and maintain its profits for years to come. Now, let's get into some simple, basic numbers. You don't need to be a financial analyst, but you should know how to check a company's vital signs. There are 3 key metrics that are easy to look up and understand. The first is the P/E ratio, or price-to-earnings ratio. This tells you how much you are paying for each dollar of the company's profits. It's like the price tag for the stock. A very high P/E ratio can mean investors expect a lot of future growth, but it can also mean the stock is expensive. A very low P/E might be a bargain, or it might signal a company in trouble. For a beginner, look for a company with a reasonable P/E ratio that's in line with its industry average. The second metric is revenue growth. Are the company's total sales growing year over year? A company can be profitable, but if its sales are stagnating or shrinking, that's a red flag for future growth. You want to see a healthy, steady uptrend. The third metric is the debt level. Look at the company's debt-to-equity ratio. A company drowning in debt is riskier, especially during economic downturns when it might struggle to make its interest payments. A company with little or manageable debt has more flexibility and is generally safer. You can find all of this information for free on sites like Yahoo Finance or your brokerage's own research platform. Just type in the ticker symbol and look for the Statistics or Financials tab. A critical part of the process, and one that most beginners skip, is identifying the potential downsides. This is called looking for the bear case. For every reason you have to buy a stock, there is a counter-argument. Your job is to seek it out. Go online and search for what is the bear case for company name. Read the critical articles. What are the risks? Is there a new competitor on the horizon? Could changing regulations hurt their business? Is their product becoming obsolete? Is the stock price already so high that it has very little room to grow? By actively looking for the negative points of view, you are stress testing your investment thesis. If, after reading the bear case, you still believe in the company's long-term future, your conviction will be much stronger. This process also prepares you mentally for the volatility ahead. If the stock drops 10% and you already understand the potential risks, you're less likely to panic and sell. You'll be able to ask yourself, has anything fundamentally changed about the business, or is this just normal market noise? Before we conclude, I need to be perfectly clear and responsible. Picking individual stocks is inherently riskier than investing in a diversified ETF. This should not be the foundation of your portfolio, especially when you're starting out. Your first stock purchase should be made with learn by doing money, an amount you are fully prepared and willing to lose. It is an educational expense. The goal here is not to make a fortune on your first pick. The goal is to learn the process, to follow a company's progress, to understand how earnings reports affect the stock price, and to become a more informed investor. The knowledge you gain from this hands-on experience is often more valuable than the financial return on that first, small investment. Even the most successful investors have picked stocks that lost money. It's part of the journey. The key is to make your mistakes small and early, and to always keep the majority of your portfolio in diversified, low-cost index funds or ETFs. So, here is your actionable checklist for picking your first stock. 1. Start with what you know. Make a list of 5 companies whose products you love and use. 2. Do the basic homework. Can you explain how they make money? Are they profitable? Do they have a competitive moat? 3. Check the simple vitals. Look at the P/E ratio, revenue growth, and debt level to ensure the company is financially healthy. 4. Seek out the bear case. Understand the risks and the reasons not to invest. And 5. Invest a small, educational amount that you are okay with losing. This is your learning lab. Follow this framework, and you will move from a state of paralysis and fear to a state of confident, informed action. You are not just throwing a dart, you are making a reasoned decision. Now I want to hear from you. What company is at the top of your research list right now? Let me know in the comments below. Thanks for watching, and I'll see you in the next one.